To remain updated with the latest business news, click on the bell icon.
Hello and welcome to this Business Today special where we are asking a lot of old-timers in the market what the budget can do this time for the stock market. I'm Udayan Mukherjee, with me is Abha Bakaya, and our special guest on the show today, Ridham Desai, Managing Director of Morgan Stanley. Ridham, good to see you on the show again. It's quite a day to have you on. Do you think it's going to turn out to be one of those years where the union budget becomes a sideshow and all the attention is hogged by volatility in global markets?
Well, yeah, potentially it can be. I mean, we've been anticipating volatility around the Fed's exit, so it's come, and that's appropriate. It doesn't mean the bull market is over. We had a similar situation in 03-04 when the Fed exited, and there was a lot of volatility. This is not 2013. I think the 04-08 cycle, as we've discussed in the past, is more relevant to this one. But of course, we'll see. The budget, yeah, I think it can still bring relevant things to the table. India has got a fair bit of idiosyncratic factors that are going for it. And amongst them is a new profit cycle. So I would still be keenly watching the budget. I mean, it is never a sideshow. Its impact on the market, though, at least short-term performance, has been waning over the past 3 decades. And even the volatility on budget day, which used to be quite intense in the 90s and the first decade of this millennium, that also has reduced a fair bit. And maybe this is because budgets have evolved. It no longer has the ingredient of indirect taxes in it. Direct taxes are far more stable. The fine print has kind of gone away. But the overall strategic thrust of the budget, I think, is still relevant. It's very relevant to how this bull market shapes up in the coming months.
We'll talk a lot about that, Ridham, but first a little bit more about this global volatility. I mean, how intense do you expect it to be? Because, I mean, the Fed seems to be ratcheting up its intensity and its urgency quite a bit in the last few pronouncements. Do you expect, I mean, a fair amount of fall has already happened in the high growth areas in the US, the expensive stocks, the technology stocks, but do you see much more ahead in the next few months?
See, I think, Udayan, I would be actually quite encouraged that the Fed has expressed this urgency, because the risk, one of the risks, and I think we discussed this on the previous show, one of the risks to the bull market was that the Fed fell behind inflation. Markets hate a Fed or a central bank that's behind inflation. It applies to the RBI as well. And the risk was that given the pandemic, central banks were taking less chances. They were being, erring on the side of dovishness, and inflation was, building up. So the fact that the Fed is a bit more urgent, aside from this volatility, is actually good news for the growth story ahead. And if the Fed, does keeps its nose ahead of inflation, the markets will actually like it eventually. This is, par for the course. We've been in an environment of very low interest rates for several quarters now. And if interest rates are going up, then as you very rightly point out, high growth stocks, which are trading at high multiples, are the ones that take it on the chin. The market is discriminating between those and the rest, where multiples may not be as rich. So the headline indices have not corrected as much as what has happened underneath. And I think that will probably remain the narrative for some time. And then you get some sort of capitulation, which I think then causes indices to bottom out. So that could be the path ahead. We still need to see what the Fed does and how exactly it pans out, and how much market prices in before the Fed event.
Okay. Back to the budget, Ridham. I mean, there are two views that the finance minister might actually take another year before she gets back to the path of fiscal consolidation, and therefore peg the coming year's fiscal deficit to say around 6.5%. There's another view that now that tax collections are so buoyant, she will now get back very urgently to the path of fiscal consolidation, which she deserted for a couple of years because of the pandemic, and therefore the fiscal deficit projection is even closer to 6%. Which one would the market like more? Which of these two options would the market like more, and what kind of stocks would come to the fore in the event of each of these outcomes?
So I think, Udayan, I would like to call it as a credible fiscal consolidation. The path is what the market will like. So the 6% number, I think, will be welcomed by the market, so far as it's backed by credible estimates. We are in one of those rare years, and actually we have to go all the way back to 2006, where government had the luxury of choosing between fiscal consolidation and spending because of buoyancy in tax revenues. So it's been a while since India has had buoyancy in tax revenues, and that's a very good thing for the markets as well, because it allows the government to make a choice. Let's boost growth further. Let's spend more money and delay fiscal consolidation for a year, or let's focus on getting to the path of normalization by consolidating the fisc with some credible numbers. I think that's the latter which the market will celebrate, because when you're spending in a growth recovery, then the risk is you invite inflation. Also, what that does, Udayan, is it actually restrains the RBI. Remember, the RBI also needs to exit, and we're expecting the RBI to hike the reverse repo rate in February and then follow it up with successive rate hikes. The Fed is on a hiking path, so the RBI can't stay far too behind. I mean, no doubt India's macro stability is a lot better than it used to be. But even then, the RBI can't stay too far behind the Fed. And if the government pursues a path which is a little bit more on the fiscal expansion side, then it does create a bit of a problem for the RBI. Now, on your second question, which I think is very interesting, is what trades? And I think this all actually points to the probability that financials deliver stellar outperformance. So the RBI is likely raising rates, which means the short end goes up, which means financials have higher yields on their assets. The liabilities reprice a lot later, so their margins expand. I reckon that after the recovery in economic activity, credit growth will follow. And we can all opine that credit costs may have peaked because profits are recovering now. So this is really, a situation which financials will really love. So I would expect that sector, which has not done so well. And you've been in the market very long, Udayan, and you know that bull markets in India have rarely been created without financials. In fact, it's hard to remember one. We have to go all the way back to the mid-90s when consumer staples drove it. So this has been a rare bull market which has not been built on outperformance by financials. So I think 2022 looks like to be a year of financials. Now, your second situation where the government chooses to spend money and not consolidate the fisc, I think will probably play into the hands of the consumer stocks. So that means more spending by the government, which I reckon will be in rural and infrastructure. So industrials and consumer stocks, I think, could do well. So those would be, how the market would react. The market will probably like the first scenario more than the second.
All right. Ridham, just want to get a take from you also on, the global bond indices. There's been a little bit of chatter around that and possibly an inclusion coming in on that front. Is that something the market is expecting to hear in the budget?
So I don't think the market is expecting it. It doesn't look like it's priced into the bond markets or the equity markets. It's something that we are expecting. And what exactly are we expecting? We're expecting clarification on the taxation of income that fixed income investors coming into the fully accessible route bonds, FAR in short, that's the acronym for fully accessible route bonds, have to pay. So essentially, it's an exemption from filing returns because Euroclear has promised the government that they will do the needful on behalf of these investors. And if the government does go to that extent, then I think it will set the stage for an inclusion of India into global bond indices in a couple of quarters from now. So maybe the third quarter of this year. Okay. Now that entails massive inflows. Just the passive flows that could come in the subsequent 12 months could be of the magnitude of $20 billion. It doesn't count for the active money that comes in. India, for the first time, will actually attract that type of inflow. And there will be a global yield profile that India will have. It will take the burden of financing the government's deficit partly away from domestic banks. So they will feel a release of liquidity, which they can then put into work into the credit market. which essentially means private investments get crowded in, and you also get a bid on the 10-year, so the yield curve flattens. So all these are really massive implications for India's growth and for India's BOP. So if this clarification comes, I think this may be the biggest takeaway from the budget.
Ridham, I also wanted to check on the LTCG. Market is rife with buzz that it might be hiked to 15%, and that's spooking investors.
Yeah, it was in the air last year as well, and it's in the air now. The introduction of long-term capital gains tax in 2018 was not such a, it was a successful experiment. The government has collected taxes, and there is this opinion that long-term capital gains tax should be aligned with the other taxes in the country. My own view is that it's still early days. India still needs a growing pool of risk capital. We can't be continuously relying on global investors to provide that for us. That's what's happened over the past 30 years. We need to encourage further flows into equities. It's a very nascent story. If investors and one of the things that equities does is provide this lower taxation benefit, especially for those who are willing to hold it for the long run. So I would hope that this incentive stays. If the incentive goes away partly, yes, you're right, it will spook the market. It did in 2018, and it could again, especially the broad market, small and mid caps, could really get hurt in the short run.
We were talking earlier about how rising interest rates globally actually flatten the valuations of some of these very expensive stocks. Do you see something like that happening in India as well, Ridham? Because there is a class of high quality, high valuation stocks which have done very well over the last 2-3 years, longer. Do you see their valuations coming off now, or do you see this global volatility actually playing into their hands as people rush to the safety of quality again?
So Udayan, there are two types of high valuation stocks. And when we say high valuation, we mean high P. I need to qualify this because, that's the way people interpret it. So let's call it high P, not high valuation. So there are two types of high P stocks. There are those which have steady cash flow and very strong cash flow generating capacity with very high return on capital. Think about the traditional consumer staple stocks or some of the consumer discretionary stocks. Companies which have very strong moats and therefore have very good cash generating capacity, have been rewarding shareholders for years, and are businesses that are unlikely to be disrupted in the coming decade or so. Those multiples, I don't think, will get threatened by this because their businesses are not dependent on low interest rates. Their businesses depend largely on growth continuing. And if anything, they've been actually grabbing share from smaller businesses and have been consolidating market share. And if growth accelerates, then they will see further uptick in their cash flow. Then there is this second variety of high PE stocks where actually those companies don't have current cash flows. Their cash flows are a bit far out in the future. They're all investing today for those future cash flows and for future return on capital. Those type of companies and the stocks of those companies may actually hurt a bit. So those that are investing for cash flows that are a bit too far in the future are the ones where I think there is a bit of a threat. So two categories, and I think that's already happening actually in the market. So it's not like the market is about to do this. Those PE multiples have come down a fair bit in the past 2 weeks or 3 weeks since the Fed made its intentions clear. Not only in India, but in fact, it started with the US and now also spreading to India and other markets around the world.
Correct. Now, a quick question on disinvestments, because this year the government is going to fall way short of its projections. What do you see the calendar of 2022 for divestments playing out like, and what ramifications could it have on the secondary market?
So I hope that the emphasis is more on privatization. That's why the national monetization plan sounded very exciting to me. Rather than just selling piecemeal stakes in government companies. And I think that shift is already underway. And hopefully that accelerates over the course of the next 12 to 24 months. The privatization brings a completely different dynamic to the table. Firstly, it's not supply into the secondary markets because it's taken off the secondary market. Second is that it creates the possibility of higher return on capital and better cash flows for these businesses, which then benefits minority shareholders that are invested in them. So hopefully the emphasis is on privatization rather than divestment. And in the event that it is privatization, if there are some delays, I think that is understandable because the process of privatization takes a whole lot longer than coming to the secondary market and offering a few shares for sale.
All right. As always, Ridham, there are so many expectations that this budget will somehow deliver a magic pill. And we all know that, they are constrained somewhat this time around. Given the kind of sell-off that we're seeing just in the build-up to the budget, I mean, we started the year on a fantastic note. We understand that, if we look forward towards the rest of the year, we're still in a super cycle. But given the kind of sell-off we're seeing right now, from a market standpoint, do you really feel that anything that's announced in the budget could possibly fire up sentiment to that extent again?
Yeah, but the history stacked up against people who want to trade this on the short run. So if you look at the past 30 budgets, and that is as far back as I go because we start from 91, 92 onwards. The 2 out of 3 times the market has gone down in the 30 days after the budget, irrespective of what the budget has done, irrespective of what the market has done prior to the budget. Now, if the market goes up before the budget, so it's trading up in the days prior to the budget, then the probability of it falling rises to 80%. So essentially, you're dealing with a situation where the market invariably tends to sell off post-budget. Now, this is purely short run. Budgets, I think, should be viewed beyond their impact on stock markets on a 15 or 30-day basis, or even a 3 or 4-day basis. And I think we should lay more emphasis on the strategic shifts that happen in terms of government financing, in terms of government spending, and in terms of taxation. So those are the things I tend to focus on. The market, I think, is up against a grim history. So if it goes up, then of course it can, because 1 out of 3 times it does go up. That's welcome. That'll be good news.
What are your colleagues in the international desk saying, Ridham, right now about how emerging markets might play out in 2022? Because now you were starting the year with this intense volatility about interest rates going up, maybe faster than what one thought before. What ramifications could it have towards flows? Because 2021 wasn't exactly a bumper year in terms of FII flows. What is this year looking like?
So see, Udayan, I think EM as a cohort has now stopped trading in unison. So this is very different from, say, the previous bull market, where EM traded as an asset class. So it traded kind of in a single direction. Within that, you had a few outperformers and underperformers. The dispersion within the EM basket has widened considerably over the past few years. And that's because various EMs have done varying degrees of structural changes. India is actually on the right-hand side, which is it has done better than most other EMs in terms of policy reform, and therefore stands to actually behave differently from the weaker EMs. But EM as a cohort, I think, ceases to really play out in the fashion it did in the past. Now, on your question on flows, I think that is going to still remain a struggle until the dust settles on the Fed and things have kind of flattened out. Right now, from a global standpoint, our strategists think Europe and Japan stand to gain from the current situation rather than EM and US. So we see more volatility in EM and US than Europe and Japan, and it's kind of playing out in that fashion. Beyond what the Fed does, I think India will, make a comeback. And for India, actually, the capital flow or, the bid in the stock market is coming from various sources. So it's not just foreign investors, as we have seen in 2021. For years, I have fielded calls from investors about what foreign investors will do. And for many, many years, I've said, why is that question so important? And 2021 has proved that it's not the most important thing for us to worry about, except from a macro perspective, which is that it does help our BOP. But that too has now diversified. We have got potential fixed income flows. We have huge amount of FDI. We have private equity flows. So many other sources of inflows have developed over the past few years, compared to, say, 20 years ago, when the only source of inflow for us used to be FDI flows. So even the macro implication of this has actually waned.
So let me ask you about the other part of inflows, which has actually been more important for us this year, which is the local money which has come in. Do you see any panic coming in there? Because this looks like it could be the first meaningful correction since the pandemic began. And a lot of the new money which has come in has probably not experienced a 20% kind of a correction. Do you think people locally will hold their nerve if we see a correction of that magnitude?
No, then they will get tested. And it's a good thing to get tested, because it will underpin their commitment to equities. We did see flows actually weaken during the pandemic period. So it was not, it was only after several months that equity investors returned after the break they took post March 2020. But the secular story in equity flows actually dates back now 4-5 years. And it's reminiscent to what happened in the US in the early 80s. Two things that happened then. Paul Volcker moved the interest rate framework to run positive real rates. And the Reagan administration allowed 401k plans to invest in equities. Very similarly in India, actually, in 2015, the same changes happened, which is the government mandated the RBI to target inflation and therefore effectively run positive real rates. And it also allowed provident funds and national pension scheme to invest in equities. So we had very similar changes, and I expect a similar path for household ownership of equities as we saw in the US in the subsequent 20 years from 1980, which was continuous inflows, which withstood a whole lot of market volatility, including the famous 1987 October Dow crash. So yes, there could be temporary slowdown in flows, there could be even outflows. But the systematic investing that India has now started, I don't think will go away. So that number did not fade even during the pandemic. I think it's unlikely to get tested by a 20% correction. The non-systematic flows that we saw, say, for example, in the month of December, they were very large. They could easily get taken out and they could turn into outflows, and that could always happen. But I think equity investing in India has arrived, and we're in for a secular run on this. Households still own only 5% or so of their balance sheet in equities. If that number has to double to 10%, which is still a pretty low number over the, say, next 10 years, I mean, you could get 50, 60, 70 billion dollars of inflow every year for the next 10 years in a growing fashion. So the household saving pool in India is not small. It's about 20% of GDP. So they're saving about $600 billion. It's not a tall ask for 50, 60 of that to go into equities, which now, by the way, would be on a 1 year, 3 year, 5 year, 10 year, 15 year, 25 and 30 year basis is the best performing asset class in India, beating gold, beating treasuries, beating property, beating every other thing that households own in much larger quantities than equities.
No question about that. No debate either on which asset class does well on the long term. But good of you to point it out, Ridham. Thank you very much for your time today. Pleasure talking to you, as always.
Thank you.
If you like the video, do like, comment, share and subscribe.